stop what you are doing. Look at this chart. This isn't a penny stock. This isn't some obscure cryptocoin being pumped and dumped on a Discord server. This is the Japanese yen, the third most traded currency on the face of the earth. Earlier today, in a span of mere minutes, the yen collapsed to 159.23 against the dollar, then violently ripped back to 157.37, before bleeding out again to 158. That kind of volatility in a G7 currency isn't just market noise. It's a heart attack. It is January 24, 2026. While you were sleeping, the Bank of Japan just held a gun to the head of the global financial system, and they refused to pull the trigger. But the real danger isn't what the central bank did, it's what the Japanese government is about to do. We are watching a collision between an unstoppable force, inflation, and an immovable object, political desperation. We are seeing the ghost of Liz Truss, the British Prime Minister who crashed the UK economy in 44 days, reincarnated in Tokyo. If you think this is just a Japan problem, check your 401k. Check your mortgage rate. If the Japanese bond market breaks, the shockwave hits New York, London, and Toronto before the opening bell rings. Today, we are dissecting the BOJ's hawkish hold, the Prime Minister's gamble that could blow up the bond market, and exactly why Wall Street is terrified of what happens in April. Buckle up. The Widowmaker trade is back. Let's peel back the first layer of this onion. The headline news is deceptively boring. The Bank of Japan left its benchmark interest rate unchanged at 0.75%. Now, 0.75% might sound like a rounding error to those of you with savings accounts in the US or Canada yielding 4% or 5%. But in the warped, upside-down world of Japanese economics, 0.75% is Everest. It is the highest borrowing cost Japan has seen in 3 decades. Since 1995, money in Japan has been essentially free. That era is dead. Governor Kazuo Ueda, the man tasked with steering this Titanic away from the iceberg, played a very dangerous game today. He held rates steady. On the surface, that sounds dovish, like he's taking it easy. But if you read the fine print, and trust me, the algorithms trading your pension fund read the fine print in microseconds, this was a hawkish hold. Here is the translation. Ueda didn't hike rates today, but he basically promised he's going to drop the hammer soon. The BOJ revised its inflation forecasts upward across the board. They are essentially admitting, yes, prices are rising faster than we thought, and yes, we are going to have to crush this with higher rates. There was even a dissenter on the board, Hajime Takada. He voted to hike immediately. He wanted to rip the band-aid off. When you have dissenters at the BOJ, a typically harmonious and polite institution, it means the pressure is boiling over. But Ueda hesitated. Why? Because he's waiting for the fallout of a snap election. He's kicking the can down the road to April. And markets hate uncertainty. When Ueda refused to give a clear, definitive signal of when the next hike is coming, the currency speculators smelled blood. They shorted the yen. They sold it like it was toxic waste. That's what drove the currency down to that 159 level. But then, the rebound. The mystery move. The yen suddenly spiked up by 2 full points. Was it the Ministry of Finance intervening? Did Finance Minister Satsuki Katayama hit the buy yen button to save the currency? When reporters shoved a microphone in her face, she gave the classic answer, no comment. This is strategic silence. They want to keep the speculators terrified. But here's the reality, whether it was a direct intervention or just twitchy algorithms unwinding their positions, the Japanese currency is on a razor's edge. Why does this matter to you? Because the yen is the funding currency for the entire world. When the yen is weak, hedge funds borrow it cheaply to buy Nvidia, to buy Apple, to buy US real estate. When the yen gets volatile, that free money spigot starts to sputter. But the central bank is only half the story. The real reason Wall Street is sweating bullets is the political drama unfolding in Tokyo's Nagatacho district. Enter Prime Minister Sanae Takaichi. She's bold, she's emboldened, and she just dissolved parliament for a snap election. She wants to solidify her power. And how does a politician buy votes in 2026? You guessed it. Free money. Takaichi has pledged to suspend the sales tax on food. She's pushing a massive fiscal expansion. We're talking about a 17.7 trillion yen stimulus package that's $112 billion pumped into an economy that is already overheating with inflation. Does this sound familiar? Let me take you back to September 2022. The United Kingdom. Prime Minister Liz Truss announces massive, unfunded tax cuts while the Bank of England is trying to fight inflation. It was gas on the fire. The British bond market collapsed. The pound almost hit parity with the dollar. Pension funds almost went insolvent. We are seeing the early stages of a Truss moment in Japan. You have the Bank of Japan trying to hit the brakes to stop inflation. You have the Prime Minister slamming on the gas pedal with tax cuts and stimulus. When you hit the brakes and the gas at the same time at 100 miles per hour, the car spins out. The bond market is already reacting. Yields on Japanese government bonds spiked this week. Why? Because investors are doing the math. If Takaichi cuts taxes, the government gets less revenue. But she wants to spend more. That means Japan has to issue more debt. Japan already has the highest debt to GDP ratio in the developed world. Who is going to buy all this new debt? This is the nightmare scenario for the global economy. If investors refuse to buy Japanese debt, yields skyrocket. If yields skyrocket, the interest payments on Japan's massive national debt become impossible to pay. To stop a default, the BOJ would have to print trillions of yen to buy the bonds. Printing trillions of yen causes hyperinflation. Hyperinflation destroys the currency. See the trap? Governor Ueda touched on this today. He said the central bank would conduct nimble operations to smooth volatility. That is central bank speak for we might have to panic buy bonds to stop a collapse. Okay, let's bring this home to your bank account. Why should a guy in Chicago or a family in Manchester care about the price of sushi in Tokyo or Takaichi's tax cuts? It comes down to two words: carry trade. For 20 years, Japan has been the world's ATM. Because interest rates were zero, investors would borrow yen for free. They would take that yen, convert it to dollars, and buy US treasuries yielding 4% or 5%. Or they'd buy the S&P 500. Or London real estate. This is a multi-trillion-dollar trade. It provides the liquidity that keeps Western markets greased and moving upward. But look at what happened today. The BOJ is holding rates at 0.75%, the highest in 30 years. Board member Takada wants to go to 1%. Some strategists, like those at All Nippon Asset Management, are asking if the pace needs to accelerate. As Japanese rates rise, the cost of borrowing that free money goes up. The profit margin on the carry trade shrinks. If Japanese yields get attractive enough, say, approaching 1.5% or 2%, Japanese life insurers and pension funds will stop buying US debt. They will sell their US treasuries and bring the money home to Tokyo to earn a safe, risk-free yield in their own currency. This is the great unwinding. If Japan stops buying US treasuries, who fills the void? The US government is issuing record debt, too. If demand drops, US yields must rise to attract buyers. Here is the domino effect for you. 1. Japan raises rates or loses control of the bond market. 2. Japanese investors sell US treasuries. 3. US treasury yields spike. 4. US mortgage rates are tied to the 10-year treasury. Your mortgage goes from 6.5% to 8%. 5. The discount rate for stocks rises. Tech stocks take a hit. The S&P 500 is floating on a sea of global liquidity. A huge chunk of that water comes from the Bank of Japan. Governor Ueda is slowly turning off the tap. PM Takaichi might accidentally smash the pipes. Either way, the pool is draining. Let's talk about the reality on the ground in Japan, because this explains why the crash is inevitable. For decades, economists said Japan was stuck in deflation. Prices never went up. It was a stagnant swamp. That swamp is now boiling. The data released today is staggering. Food prices in Japan are up 5.1% year over year. Core inflation is at 2.4%. Inflation has now averaged above the BOJ's 2% target for 4 consecutive years. This isn't a transitory blip. This is entrenched. Takaichi's plan to cut food taxes is a desperate attempt to help voters who are getting crushed. But the BOJ knows that tax cuts usually increase demand, which creates more inflation. Governor Ueda explicitly said, April is a month where there's relatively high numbers of price revisions. He is signaling that April is the danger zone. That's when corporate Japan resets prices for the new fiscal year. If wage hikes in the spring are strong, and companies hike prices again, the BOJ will have no choice. They will have to hike rates aggressively. Yoshimasa Maruyama at SMBC Nikko Securities put it bluntly, I see a rising chance of a rate hike in April. But here is the catch-22. The yen is weak because rates are still relatively low compared to the US. This weak yen makes imports more expensive for Japan. This imports more inflation. So, the BOJ must hike rates to strengthen the yen and stop inflation. But if they hike rates too fast, they crash the economy and blow up the government's debt interest payments. It is a trap. And today, Ueda decided to sit still in the trap for one more month. But the walls are closing in. So, where do we go from here? As we look toward the April meeting and the aftermath of Takaichi's election gamble, there are 3 scenarios you need to prepare for. Scenario 1, the soft landing miracle. Takaichi wins the election but moderates her spending plans. The US Federal Reserve cuts rates aggressively, narrowing the gap between the US and Japan. The yen naturally strengthens to 140 without a crisis. The carry trade unwinds slowly, over years, not days. The S&P 500 stays intact. This is what everyone is hoping for. It's also the least likely because it requires politicians to be responsible. Scenario 2, the bond vigilante attack. Takaichi pushes through the full tax cut package. The bond market revolts. JGB yields spike vertically. The BOJ is forced to intervene with massive QE, which sends the yen crashing to 170 or 180. The cost of living in Japan becomes unbearable. The government falls, or the BOJ is forced into an emergency shock and a rate hike that triggers a global recession. In this scenario, hold cash and gold. Scenario 3, the April surprise. The BOJ sees the inflation data in April and decides they are behind the curve. They hike not by 0.25%, but by 0.5% or more. They signal a rapid return to normal rates of 2% or 3%. This shocks the global system. The carry trade implodes instantly. We see a Black Monday-style event in Western stock markets as margin calls hit hedge funds globally. The yen rips from 160 to 130 in a month. This crashes the Japanese export sector but saves the currency. The market behavior we saw today, the 2-point swing in the yen, tells me the market is nervous about scenario 2 and 3. The twitchy algo platforms are programming in disaster risk. Also, notice the nuance in the BOJ statement about the US. They cut the wording about watching the US economy without preconceptions. They see the risk of US tariffs receding. They feel safer to act. That means the leash is off. We often ignore Japan. It's an aging society. It's far away. It's been economically dormant for 30 years. We think of it as a place for anime, great food, and polite tourists. But financially, Japan is the load-bearing pillar of the global debt market. Today, January 24, 2026, we saw a crack in that pillar. Governor Ueda is trying to patch it with hawkish words and a steady hand. Prime Minister Takaichi is standing next to him with a jackhammer, promising tax cuts that the country cannot afford. The yen is screaming. It's telling us that something is broken. If you are holding US stocks, you are implicitly shorting the yen. You are betting that the global flow of cheap liquidity continues. My advice? Watch the 10-year JGB yield. Watch the US dollar to Japanese yen exchange rate. If the yen breaks 160 and stays there, or if it violently strengthens to 140 in a week, the game has changed. Don't be the investor picking up pennies in front of a steamroller. The carry trade party has been going on for decades, but the lights just flickered. The music is stopping. Are you ready for the silence? Thanks for watching. If you want to understand how to hedge against a currency collapse, check out the link in the description for my deep dive on defensive assets. And as always, subscribe and turn on notifications, because when this story breaks, you need to be the first to know. I'll see you in the markets.